Hello, friends. I have some questions here that are likely to appear on a test. So these are the things we have been talking and doing for the past few weeks. So with these problems, let's just go ahead and start with them. So we have, to begin with this, we have this company that is coming up with a new product that's a tracking device. Okay. Tracking device, and the company is anxious to begin this new device, yes, as we can say. But according to their survey, these are the information we need to find out what the company, how much the company will need to invest in the equipment that will produce this new product. Okay. So I've always told my students that when you have a problem, accounting problem, begin with what you know, okay? And as you begin with what you know, and then we'll figure out what you don't know. That's always a good thing to do. That has helped me over the past years. So this is what we're going to do. What do we know here? We know that the new equipment that they need to produce this new product will last for 12 years. So the investment is 12 years period, okay? So I have my template here. I'm going to put this template here, over here. Okay, so I have my initial investment right now, and then for the period of 12 years. Okay, now as we move on, we're going to find the initial outlay of working capital. So at the moment, the company is going to invest 60,000 right now, okay, as a working capital. So it's a cash outflow. So we're going to put a negative 60,000, okay? But remember, because it's a working capital, the company will get it back at the end of the investment, okay? So at the end of the 12 years, the company will have an inflow of 60,000 of that investment, okay, of that working capital. Remember, working capital goes in and always comes out. Okay, it goes in and always comes out. And salvage value also always comes out. Okay, so now let's continue with that. Great. Now, what is our annual net cash flow? What it is? It could be cash inflow or cash outflow. What is our annual net cash flow? And we have this information to find our annual net cash flow. And it says the contribution margin per unit is $20. Okay, so let's, for instance, we know when we're doing the contribution margin income statement, we have sales, we have variable costs, and we have contribution margin. Okay, here we already have variable cost taken out, and then the contribution margin is this. So contribution margin is $20 multiplied by the unit. Okay, so $20 per unit. Okay. But before we will know our cash inflow or our annual net cash flow, we will have to subtract some cost. Okay, so we have here fixed cost is 135,000. So fixed cost is 135,000. And then we have an increased advertisement, which was 120,000. So advert is 120,000. So in general, the total cost that will be subtracted from contribution margin will be this plus that, which is 255,000, will be taken out from the contribution margin. Okay, so now let's find the annual net cash flow for our first year. So the first year we have $20 with the contribution margin multiplied by 6,000 in the first year. So 6,000 units were produced. Okay, but we have to subtract our total cost, which is 255,000. Okay, so that is our annual net flow for the first year. Okay, now for the second year, we have what, $20 multiplied by 12,000 units minus our 255,000. Okay, that's our annual net cash flow for the second year. The third year, $20 multiplied by 15,000 minus this 255,000. Okay, that's annual net cash flow. But notice from the fourth to the eighth, from the fourth to the 12th year, the units were the same. Okay, so we're going to have the same thing to do. 12 multiplied by the 18,000 minus 255,000 gives us 105,000. Okay, so I'm going to just drag reference this one here. Once I reference it, I can drag it all the way. Okay. Now notice that I didn't drag it all the way to year 12 because we already have a 60,000 there. So what I'm going to do is I'm going to add this 105,000 to it. Okay. What is basically is we have 20 unit multiplied by 18,000 minus this 250,000. Okay. But the company has invested. The company has a working capital of 60,000 that they need to get back. So 60,000, that will give us the 165,000. So that is why we have that one. Okay, now we know our working capital is 60,000, but we don't know what the equipment is. Okay, how much do they need to invest to get equipment? I'm going to walk you through, okay, to understand it. Okay, it's better than just telling you what to do straightforward. Okay, I'm going to go slow with you with this one. Now, for this reason, I'm going to find the present value for each year. Okay, we're going to work our way backwards. Okay, so this is how you find the present value for each year. 1 divided by, you open parenthesis, 1 plus, what is the rate? The rate is 14%, so 0.14, that's 14%. Okay, you close the parenthesis, raise the power 1 because that is year 1. Okay, that's the exponent to be multiplied by the net cash flow. Okay, so the present value of 135,000 negative is 118,000. Okay, so what I'm going to do is with the second year, I'm going to drag it and then just change the exponent. Okay, because now it's built up, so I'm going to change the exponents to 2. Okay, so that's the net present value. I'm just, okay, on the third one, I'm going to change the exponent to 3. Okay, so at this point, I'm just going to drag it all the way to the 12th year and then just keep changing the exponent. Okay, so this exponent, I'm going to change it to 4. Change this exponent to 5 was the 5th year. Change this exponent to 6th year. Change this exponent to 7. Change this exponent to 8. Exponent 9. Exponent 10. Was that 10? Yeah, that was 10. Okay, exponent 11. And then exponent 12. Okay, so the present value for each net cash flow in each year. Okay, now we're going to sum them up together. Okay, so this is what the company needs to invest. Okay, including the equipment and the working capital. But a company has already put out the 60,000 of the working capital here. Okay, so to find out what the equipment will cost, we will take this one and subtract the 60,000 of working capital. So the equipment will cost 203,000. Okay, now let's add the cost of the equipment here. Okay, so we have the equipment minus 203,000 because it's a cash outflow. So we have here 263,421. Okay, so the equipment cost will be 203,000. That is the answer for the equipment cost. Okay, but let's double check to see if we are right. Okay, let's see. If we are right, let's find our net present value. So our net present value NPV. What is the rate? The rate is 14%. Okay, and then we select all the cash flow. Okay. If we are right, this should give us 0 if we are right. Okay, the net present value should be 0. Okay. Now plus the initial investment, okay, which gives us 0. Okay, so that means we were right with how much the company needs to invest in the net present value. Okay. So now let's check what the return actually is. Internal rate of return, if we are right with that one too. So we have our, let's find internal rate of return, IRR, okay? That will give us equal to, you type in the IRR, open parenthesis and select all the value, close it, that is 14%, okay? So you know we were right, exactly 14%. Okay, so we know we were right, okay, with what we just did. Okay, trust me? Great. Okay, now let's move on with the next one. I'm glad this makes sense. Let's move on to the next one. So we have this, and we have this company too, now debating whether to keep an old machine or to buy a new machine. Okay, so we use the same template to find out. Okay, I've always told you, find out what you know and then figure out what you don't know. Okay, so I have this template here that I'm going to use. We know the investment is apparently 6 years. Okay, so I'll put this one here. But what I'm going to do is this is, okay, come on. Okay, so this is for the old machine. Okay, let's pretend this is the old machine. We're going to compare these two, and this is the new machine. Okay, so the old machine, new machine, they're both going to last for 6 years. Okay, so considering a new machine is available, that will be substantially reduce the operating cost. The company has a 10 hurdle rate. Okay, what's your recommendation? Okay, we know with the old machine, okay, if we keep the old machine, sorry about that. Okay, if we keep the old machine, okay, what investment do we have to do right now? Okay, as you can see, the investment we have to do if we keep the old machine is to do overhaul of 40,000. Okay, so that is a cash outflow. Okay, so we put the 40,000 here, right? Okay, now what is our annual cash flow? Okay, we will spend, says we will spend 30,000 here. Okay, annual net cash flow, we will spend 150,000 every year. Okay, so this is cash outflow. So this is a cash outflow. Gives us a cash outflow all the way. Okay, so every year we will spend this much on the keeping the old machine. Okay, which is 150,000. So we have 150,000. Okay, for the whole year. So we're just gonna reference it and then drag it all the way to the 6th year. Okay, what else do we have here? Okay, the salvage value. Salvage value in the 6 years will be 0, so we don't have any salvage value that we need. Okay, great. So now, what is our net present value if we keep the old machine? We have NPV, have money here, equal to, type in NPV, and next thing knows what we mean. And then what is the hurdle rate? The hurdle rate tells us is 10% over here. So 0.1, press comma, and I select everything here, close parenthesis, plus the initial investment required. Okay, so this is our net present value with negative 693,000. Good. Now let's move on to the new machine. Okay, now we have the new machine here. What is the initial investment that we need to do in our new machine? The initial investment said we'll purchase the cost for 250,000. Okay, 250,000. But because we are selling it, okay, we are selling, because we are buying new machine, we will be getting rid of the old machine. And the old machine is worth 30,000. Okay, so we will have that cash coming to us right now. We will spend this, but we will have this cash. So that will reduce our initial or investment required at the beginning. Okay, so what we will do is we will spend 250,000. Okay, that is a cash outflow going out as negative. Okay, but we will have a cash coming to us, cash of 30,000 coming to us. Okay, so we have 220,000 that we are spending actually. Okay, now Annual cash net operating. So this one too is a cash outflow. Okay, so everything that's going out is cash outflow. Coming in is cash inflow. So cash outflow of 90,000 right here. We will spend only 90,000. So we have 90 as a cash outflow. So I'm just going to reference this all the way throughout the 6 year. Okay, but notice at the end of the year, the salvage value of the new machine will be 50,000. So we'll get that money back, okay, at the end of the year. So that will actually reduce our cost. So we have plus 50,000, okay. So this is what we have here as 50,000, okay. So our net present value, if I copy and paste this here, okay, that will compute my net present value of 583,749. Great. Okay, so with this one, what is your recommendation? What should we do? Now find the difference. This, which one is worse, which one is better? Net present value we know is worth 693, 593. So this one is better. Okay, so the difference will be okay. The difference will give us this of 109,539. Okay, so what we will do is we'll tell the management the new machine the new machine will favor us. Will spend 109,539,000 less. Okay, so that's what our recommendation is, to buy the new machine instead of keeping the old machine. Okay, great. Now let's move on to the next question. We have here. What do we have here? Okay, so we find that we have a similar problem, okay, similar problem as we know. But in this problem, we're only going to consider buying a new machine, okay, and we'll find, or buying a new machine, and we will see what the net present value will be, okay. So now find out what you need to know, or what you know right now, okay. Says replacing one of its machine with a newer one, okay? The old machine has a book value of 600,000 and remaining useful life for 5 years. There'll be no salvage value. And so the only thing that is needed in this information is at the time, but it can be sold at this time for 205,000. This is the only information that is needed here, okay? Everything here is useless, okay? That is accounted for you, okay? Now we have the new machine. We'll purchase it at this, okay? So remember, we are purchasing this new machine at this cost, and it will last us for 5 years, okay? And the salvage value at the end is 145,000, okay? And it will save us 225,000. These are the information you need, okay? Now let's move on, and a copy is going to cost us 5 years. So we're solving this problem, okay? It's going to last us for 5 years. Okay, so I have it here. Now, what is the investment that we need to do right now? Okay, we need to spend 1,175,000. Okay, that is a cash outflow going out. Okay, but luckily, because we buy the new machine and replace the old one, we are going to get rid of the old machine, which at this time is worth 265,000. So we'll get that cash coming to us. So that will be a cash inflow. Okay, so that will reduce how much we need to invest. Okay, so we have 265,000. Okay, so we are actually going to spend 910,000 on the machine. Okay, great. Now, what else do we need to know? We have this 5 years, the salvage value at the end of the year. That's what we're going to get back. But we have here annual savings. So it's going to save us 225,000. That becomes a cash inflow coming to us. It's a savings. Okay, we're not going to spend that anymore. It's going to come to us. So we're going to have 250, oh, what it is, 225,000, okay, of annual net cash flow every year. Okay, so we're going to reference that and drag it all the way here. Okay, but in the 5th year, we have a salvage value of 145,000. When we're done, when we get rid of the new machine, we can sell it for 145,000. So that will be a cash inflow, cash coming to us. So we have 145,000 of that. So at the end of the 5th year, we have 370,000 that we'll get. Okay. Now they want to know, what is the net present value of the new machine? All you need to do, you have your NPV here. Okay, press equal to, type NPV, select this, and then what is the rate? Okay, the rate, we were given the rate as 12% right here. Okay, so 0.12. Okay, type comma and select all the cash flows. Okay, close the parentheses plus the initial investment. That gives you 16,648. So that's the net present value of it. Okay, so if you want to find at what rate would the net present value be 0? Okay, because we know this is negative, so that is not good. At what rate would the net present value be 0? You will use the IRR to find that. You want to find the rate. Okay, so you select everything here. That wasn't asked, but that will be helpful. So at the rate of 11%, the net present value will be 0. Okay, let's find out and see. So we have our NPV, we open parentheses. Let's select this rate, comma, okay. Select everything here, close parentheses, plus the 910,000. So the NPV will be 0 at the rate of 11%. Okay. So if they were to invest at the higher rate of 11%, they would have a net present value of 0. Okay, but this one is negative. Okay. So let's move on now that we have this one good. I'm glad everything is going well right now. So we have a next problem here that we are considering. This company is considering whether to renovate this site or to get a new site. Okay, to renovate or get a new site. Now, let's find out what do we know. We start with what we know and we find out what we don't know. Okay, great. So we have here this the boat company and everything, blah 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 blah. So if we are going to renovate, okay, we will renovate at the immediate cost of 200,000. So we know this goes into the renovation. Okay, further repairs or overhaul of the motor will be 5 years from now. Okay, so 5 years from now we will have another cost of 80,000. Okay, and this will extend the useful life for 10 years. Okay, so that for 10 years instead of 5 years. Okay, so that means we know we are dealing with 10 years problem. Okay, at the end of the 10 year, the salvage value estimate was 60,000. Okay, the salvage value at the moment is 70,000. I'm just letting you mention it. It will cost 300,000 each year to operate the ferry, and the revenue will total 400,000. Okay. However, this is the old machine. The new machine, or to buy a new, okay, renovating and then buying a new. To buy a new site for the boat, it will cost 360,000. Let me use a different color for this one. It will cost 360,000, and the useful life is 10 years. So we know we are dealing with 10 years with both renovating or buying a new one. Okay. We need to repair during 5 years of 30,000, and the scrap value at the end of 10 years has 60,000. Okay, it only costs 210,000 per year to operate the machine. Okay, now let me go and use the template over here. So we know we are dealing with 10 years. Okay, which problem? Yeah, Nephi's problem. I love Nephi. Okay, he was a good guy. So we have here the new. We're going to just copy it right here again. So we do it how we did the previous one. So we're going to consider renovation and new site. Okay. We're going to consider these two. Okay, so with renovating, what is the investment we need to put in if we want to renovate it? Okay, and it says here at immediate cost of 200,000. Okay, so we need to spend 200,000. So that's the cash outflow of 200,000. Okay, so the company will need to spend 200,000 going out to renovate the site. Okay, now what is our annual net cash flow? What it is? Okay, it says here it will cost 300,000 each year to operate but revenue will be 400,000. So in real sense, actually the cash flow or cash inflow coming to us is only 100,000. That is the 400,000 minus the 300,000 cost. So we only having net cash flow of 100,000 each year. Okay, so because it's annual thing, just reference it all the way till year 10. Okay, so this is the annual cash inflow that will come to us. But we are not done. Okay, we are not done with that. Okay, we have some information here too. It says the motor will be needed 5 years from now at a cost of overhaul will be needed, okay, at a cost of 80,000. So in 5 years, the company will spend 80,000 to overhaul it. So although we have 100,000 cash inflow, we will spend 80,000 out of that 100,000. So in the 5th year, we only have 20,000 of cash inflow. So I get to change this one so I won't have a problem with the certain. Okay, great. Okay, so in the 5th year, we have 20,000 by 100,000 moving on. Okay. Great, and let's move on with it. At the end of the year, at the end of the 10 years, the salvage value will be 60,000. Okay, so at the end of the 10 years, the company will have 60,000 when they get rid of the machine. Okay, that's the salvage value. So plus 60,000. Okay, so that is 60,000, 160,000 cash inflow at the end of 10 years. Did you see how we did that? Okay, so we have the investment, everything will be 100,000 cash inflow, but 5th year we will spend 80,000. That will reduce our cash inflow, and then the salvage value of 60,000 will increase our cash inflow. Okay, now great. Let's find the net present value. So we have our NPV here. That's all what they want us to find. That one. So we equal to, we have NPV in parentheses. What is the rate? The rate is 14%. So 0.14. We press comma, and then we select all our cash flows. Okay, close parentheses plus the initial investment. Okay, so that gives us 296,000 of net present value if we have the renovation. Okay, so I've been at the renovation. That what is the IRR if you want to find the internal rate of return? So let's just find the internal rate of return. Okay, it's fun to finding that one. So IRR, you open parentheses, you select everything here. Okay, you close parentheses, you press equal to that. That's 46% of internal rate of return. That's good. That's good. Okay, let's see what about the new side. Okay, if we keep the new side, what it's going to do. If we decide to get rid of the old side, okay, as soon as we decide to get rid of it, it says we have a salvage value of 70,000 at the moment. So if we get rid of it, we are having 70,000 of cash coming to us. Okay, but we will have to spend the side 360,000, okay, to buy the new side. So that's a cash outflow of 360,000. And because we got rid of the old side, we will have 70,000 because it's worth that much. So that will reduce our investment. Okay, so in essence, we are only spending 290,000. Okay, because this 70,000, when we got rid of it, reduce how much we will spend. Okay, it will last for 10 years. We already know that. Okay, and then what we have here is in the 5th year. Okay, it will need repairs during the 5th year. Okay, so in the 5th year, we know we will spend cash outflow, okay, of 50,000. 50,000 will go here, okay, and in the 10th year, the scrap value will be 60,000. So we are having scrap value the same as the salvage value, okay. If we get rid of the machine, we will have 60,000 coming to us, okay. The 10th year. Now, it will only cost 210,000 per year to operate because of understand this one. Okay, what does that mean? It will only cost 210,000 per year to operate because of, okay, great. So what it means here is, okay, it will reduce our cost. Okay, so at the moment we spend 300,000. okay, to operate. Okay, so we have 400,000 minus 300,000. Okay, and then inflow is 100,000. But if we use the new machine, our cost will be only 210,000. So instead of 300,000, it's 210,000. So what will be our cash inflow? That is 400,000 minus the 200,000. So our cash inflow is 190,000. Okay, so we will have cash inflow of 190,000 every year. Okay, so if I reference this and drag it all the way here, okay, when we get here, we have a negative 50,000 here. So what I'm going to do is I'm going to add this one to this, and that reduces to 140,000 in a fifth year. Okay. Fifth year. Actually, in the fifth year, we will spend 30,000 to renovate. Okay, I use the 50,000 over there. So sorry, it's 30,000 in the fifth year to cost 30,000. That was a typo. Okay, so 160,000 here, and we don't do anything in the sixth year, so we're going to have the same 190,000. We drag it all the way here, but we have 60,000 already here, so we add it up. Okay, so in the 10th year we have 250,000. Okay, because I already have it computed, I just copy and paste here, and that gives me my 701,000 as my net present value. And what is my internal rate of return? I just copy and paste it here. That's 54.61. Okay, so that it is for this problem. Let's move on to the next one. You can feel free to pause the video and review and watch how I did it. Okay, let's go move on to exercise 13 and 16. What is happening here? Okay. This one, we will need to determine the NPV and the IRR explained in the project. Okay, great. All right, so we have this information here. Right, and in general cost, and they are considered. So this is the information we have here, okay, to find what it is. Okay. Now, find out what you know, and then put down what you know and figure out what you don't know. We know the investment is going to cost 4 years of mining. So we know the investment will be 4 years. So if I have my template, I just do up to 4 years. Copy and paste here. I love copy and paste. It's so awesome. Okay, so we have it here. Okay, 4 years. Okay, and then company's rate is 20%. Okay, great. What do they want us to do? Okay, cost of a new equipment and timbers will be 275,000. Okay, so to invest in this, we will need to spend 275,000. But that is not all. We have a working capital. So spend 275,000 on equipment and then 100,000 on a working capital. So minus 100,000. So our investment will spend 375,000 to invest. But remember, because this is a working capital, okay, working capital always will come back to you. It's going, come up, going, come up, okay? So working capital always will come back to you, okay? So because we have 100,000, at the end of the 4th year, we will have 100,000 coming to us. So we'll get the working capital back. Great. What else do we need to do here? It says annual net cash received is 120,000, and cost to repair in the 4th year is this, and then the salvage value is that. Okay, so this is pretty simple, straightforward. Okay, annual net cash flow is 120,000, so you put 120,000 here, and then you references part to part references here. Okay. Oh, Alexa, don't do that to me. Okay, your references here. Okay, but here, because you already have the 100,000, you will add it to 120,000. Okay. We are not done. We are not done at all. Okay. And then it says the cost to repair is in the 3rd year will be 40,000. So in 3rd year, we will spend 40,000 repair. That will reduce our cash inflow. So 40,000. Okay. Okay, this one, mess this one up. Instead of 120,000. Okay. So we have 80,000 in the 3rd year. Okay, great. In the fifth year, at the end, or in the fourth year, at the end of everything, you can tell I'm getting tired now. We will finish. We have one more problem, or I think two. In the fifth year, we will have a salvage value of 65,000. Okay, so that will be an increase coming to us. So we have 65,000. Okay, so 85,000 will be the annual cash flow in the fourth year. Okay, now what is our net present value? So NPV, like we have been doing always, type equal to NPV, open parenthesis. What is the rate? It says here 20%, so 0.2, comma. Select year 1 to year 4, select only the cash flows, and then plus the investment. Okay, so our net present value is 79 over there. Okay, now you want to know, this is negative, this is bad. Okay, so at what rate, okay, will I not be in the negative zone? That's when you use your IRR. Okay, it's not a common IRR, and you select everything over here. That's 90%. So at the rate of 90%, we should have a net present value of 0. So let's find out if that is true. So NPV, we select this rate, comma, select everything here, close parenthesis, plus the investment. That gives us 0 net NPV. Great. So you have that one down. Let's move on to the next one. Okay. Problem 1317. We have here a similar problem. I think I've done this one before. Yeah. Familiar with this. Okay. So we have this. Now, what do we know? What do we not know? What we know is the investment is going to take 5 years. Let's begin on that knowledge. Okay. So because I already have this one here, it's fit here. I'm going to copy this one for 5 years and put it here. Okay, this amount are not all right, say, okay, so I'll have it here. It's going to last for 5 years, okay? And what is my investment? What do I need to invest right now? It says here, will require 3.5 million investment, okay? Right over here. So what I will do is I will just cash outflow of 3.5 million of cash outflow is getting late. Okay, cash out for 3.5 million. Okay. And now, what is my cash inflow? This seems to be like income statement. Okay. So once you have the income statement, all you need to do is look for the net operating income. Once you find the net operating income, add back depreciation costs. Okay. Because this is not your net cash inflow. Depreciation cost here is not an expense that you spend money on. Okay. If you do a cash, what do we call a cash flow statement, you will always add back depreciation. Okay. If you have studied that, that's in chapter 14 of this book. Okay. You will always add back the depreciation cost. So look for your net present value, this, and I will add back my depreciation. That will give me my net cash inflow. So we have this one plus the depreciation cost, which gives us 110. So my annual net cash inflow is 1.1 million. Okay, so I will just reference it. This is pretty easy. And I will just drag it all the way here. That gives me that one. Okay, so with a fit here, this is what I'm going to have. Okay, what is my net present value? Okay, that's question one, net present value of the project. So I have my NPV here. I press equal to NPV, open parenthesis. What is my rate? We're given the rate. Where is the rate? 16%, okay? So 0.16, comma. I will select all my inflow, close parenthesis, plus the investment. Okay, so I have 101,723. That's my net present value. Okay, let's move on to the next one. What is my IRR? Okay, you don't even need to copy and paste everything here. Just put here IRR. Okay, and then type in IRR, open parenthesis, select everything here, close parenthesis, press enter. What did we do? That did not give us the error. Wow. Actually, that is right. It's just in not in percentage. Okay, right. So I changed the formatting. So that's 17%. Or if you want to see the decimal, 17.24 is IRR. Okay, what is our third question? What is the project simple rate of return? Okay. Now the question 3, simple rate of return. What is the formula for simple rate of return? That is your annual net operating income. I'm just going to do it knowing annual net operating income divided by initial investment. Initial investment. Okay, so what is my annual net operating income? We already have it here. Net is net operating income 400,000. Great. And what is my initial investment? What did I need to invest? Okay, needed to invest 305 million. Okay, so remember I put negative here, so I had to change it to positive because I have negative here. Okay, so you have it here. So your simple rate of return will be this one divided by the 3.5 million. So this is your answer for simple of return. Okay, that gives us 11.43%. Okay, now with this, the fourth question is, should Casey pursue this investment? Would you do it if it were the one? Now listen here. Okay. Well, we have a net present value of this one. Okay, so the company will want Casey to do. Okay, I have solved this problem before, so I know the question here is not complete. Okay, but what it is the company, Casey has 20%. So in case Casey has a return rate of 20% as a history, okay, historical rate of 20%. Okay, then Casey will not do it because this is 17%, which is lower than his historical rate. And the higher the simple rate of return, the higher his incentive. So he gets higher incentive. But because this is lower, then he's not going to do it. Okay. But if his historical was to be 12%, then Casey will do it because this will give him incentive. This will give him bonus because the simple rate of return is higher. The higher your simple rate of return, the better it is for you as a manager. But the company will be like, okay, this is positive net present value. Let's do it. We want it. But according to Casey, it depends on what his historical rate of return is. Okay. So the question that I got is not complete here, but in the actual book, that is what the question is. Okay. We have two more. Okay. We're going to finish right now. All right. This problem, what is this? What does this problem want us to do? Okay, so we have here, it says the total time available injection, which is the least, okay, which product will be the most profitable use of this constraint? So this is the constraint. Constraints we know is something that prevents something from happening. Okay, so we have two companies here. So no, we have the same company, but we have this product. So I'm going to copy and paste here, ski, golf, and then fishing. Okay, so we want to know which one will invest. Okay, so what we will do is we will find first the profit, and then we divide by the minutes that is going to cost. Okay, so you find the profit first, and if your profit, for instance, this one we have 200 minus the variable cost. Okay, so our contribution margin is 140, but it will take us 2 minutes to make a profit of 140. Okay. So with this, what we're going to do here, we have our contribution margin minus 60. Okay. Well, we're going to close it here. Minus 60, but it will take us 2 minutes. Okay. To make it. So 70, we will make $70 per minute according to the constraint. Okay. Let's move on to the next one. We have here 300 minus contribution margin 140, get the contribution. And what is the minute? It will take us 5 minutes. Okay, so 5 minutes is the constraint. Okay, so it will take us $32 per minute. Okay, I'm just gonna copy and paste here. I'm just trying to finish this quickly. Okay, so with the third one, you find the contribution margin. Okay, and then you divide that by the constraint. So the contribution margin is 250 minus, oh no, the selling price minus the variable cost, and then divided by the minutes. The minute is 4. Okay, so that is 50 constraint. Okay, so according to you, which one is the least, and which one would you is most profitable? It's obvious there. The $70, the ski car guard is most profitable. Number 2, we have another constraint. Okay, this is a different constraint, and we're going to use the same procedure, the same way we found this one to find it. So I'm just going to copy and paste this one and put it here. Okay. Now, what is our contribution margin? Okay, so we will find it here. This one minus 60, we close parentheses, divided by what is the constraint? 7 pounds. Okay, so the constraint is 7 pounds. So divided by 7. So it's 20 per, this is pounds, okay? 20 per pounds. Okay, that's the constraint. Now let's find the second one, okay? For golf guard, we have this selling price minus this one. That gives us the contribution margin. That's the contribution margin divided by the constraint. Constraint 4 pounds, okay? So $40 per pound. Okay, that's what we're going to get. So we do the third one, which is fishing guard minus 55, close it, divided by what is the constraint? The constraint is 8 pounds. Okay. So according to it, according to the pounds constraint, which one is favorable? Obviously, golf guard is favorable according to this constraint. So all you need to do is find the contribution margin, that the selling minus the variable, is what we have, okay? But it will take us 2 minutes to make this. It will take us 5 minutes to make the contribution margin. So how long is it going to take you to make a profit? That's what you're trying to do. And contribution margin is a profit, okay? We are going to do the last one. I'm speeding up. So this is the last one. This is an interesting one. Okay, this kind of confuses students when it comes to deciding whether to make or buy. Okay, so we have a company here that produces or manufactures 12,000 microphones annually. Okay, this direct material, this direct labor, this variable manufacturing overhead, and fixed manufacturing overhead. Okay, and the total is 9.7. Okay, so we're going to compare, but they want to buy microchips or microphone from a company. Remember, they're going to buy the same 12,000 unit. So that makes our work super easy. And they will spend $7 per unit. Okay, so now let's compare them. Okay, I'm going to make a table with make or buy. This is make, this is buy. Okay. 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 If we make them, this is the column. Let me select and make it colorful so it looks good. Okay, looks pleasant. Okay, all right, that's the word I was looking for. Looks pleasant, good. Okay, great. So we are deciding we are going to decide for the company whether they should buy or make. Okay, great. If they make it, okay, if they make it at this point, they are going to spend $9.7. That's the total cost multiplied by 12,000 units. Okay, if they make it, this is how much they are spending, 12,000 units. There's no cost again. Okay, if they buy it, okay, they will buy 12,000 units at the cost of $7. So they will spend 7 multiplied by 12,000 units. Okay, that's how much they will spend. Okay, 84,000. Okay, but that is not all. let's keep reading. It says, Ellen product decide to purchase instead of producing, then the facilities being used currently could be rented to another company for an annual rental of 40,000. Okay, so because they will be buying it, can rent the facility. That will reduce their cost because remember, when we're making decision, which one is valuable, relevant, which one is not relevant, they will never get 40,000 if they didn't decide to buy. So this is relevant when it comes to this making decision to buy. So that will reduce their cost 40,000. Okay, so that will reduce their cost of 40,000. But it also says 75% of the current fixed manufacturing overhead will be unavoided. So no matter what it is, they will still spend 75% on the fixed manufacturing overhead. Okay, so now we know 75%. So what is the 75%? So 75% of fixed manufacturing or this manufacturing overhead, 75% of it, they will have to incur that cost. So what is 75% per unit? We have here 0.75 multiplied by this. Okay, so every unit, they will have to spend $3.75 on fixed manufacturing costs. So that's what we're going to do here, okay? We have fixed manufacturing costs here multiplied by 12,000 units because they are buying 12,000 phones. Okay, so they will spend 45,000 on fixed manufacturing overhead. Okay, now let's add them together. With here, we know the company will spend 116,000 if they decide to keep making them. But right here, the company will spend only 89,000 if they decide to buy. Okay, so should the company buy or should the company make it? We know this is less cost. It's going to cost them 89,000 if they buy it. But currently they are spending 116,400. And it says, what will be your recommend? My recommend is let's buy it because that will give us less cost. Okay, provide the detailed justification. That's what we already did here for answer. You could how much profit they will say. Okay, how much profit will the company save? That is this one minus that. So the company will make a profit of 27,400 if they decide to buy it. Okay. All right. That's the end of our lesson or tutorial today. It's been a long day and it's been a long problems to go through, but I hope it all makes sense. And I know it did because I really took my time to make sure you understand them. So feel free to pause the video or go back and forth and then review them so you understand them perfectly. I will see you again next time. Bye-bye.